Hello and welcome, and in this stock analysis video I will share with you my simple investing process which has helped me get a consistent return of over 20%. So in today's stock analysis we're going to look at Teladoc Health. Let's find out about the company. Teladoc Health was founded in 2002 and was later IPO'd in 2015. Teladoc Health offers virtual medical services such as online medical advice, mental health care, counseling through websites, and apps and text-based interactions. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarize our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. The earnings per share is down by 2%. Now let's look at the free cash flow, which is the money a business can generate from its operations. Free cash flow has increased by 1%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Revenue is down by 1% for the trailing 12 months. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. Book value is minus 4%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. Return on invested capital is minus 6%, return on equity is minus 10%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. Debt would take nearly 8 years to be paid off. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. Gross margin is 71%. Next we come to the operating profit margin. This tells us how much profit a company makes on a dollar of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. Operating profit margin is down by 10%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for a company that has a free cash flow yield of 5% or higher. Free cash flow yield is really healthy at 9.96%. After that we come to the PE ratio, which Peter Lynch believes is a key indicator when evaluating if a company is under or overvalued. The PE ratio is minus 9.2. And lastly, we come to the enterprise value divided by earnings before interest and taxes. Like Peter Lynch, Joel Greenblatt uses this metric to identify if a company represents value for money. We'll come back to Peter Lynch and Joel Greenblatt's valuations later on. The enterprise value to EBIT is minus 11.85. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. There are currently 2 super investors who are selling this company, but nobody is buying. If we look back at Cathy Wood's previous sales and purchases, we can see that she has both bought and sold Teladoc Health in the past few years, but has recently sold 5 million shares in the last quarter. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. If we look back at the past performance of Teladoc Health, we can see that in 2015 until 2020, their share price rose significantly during the pandemic, and unsurprisingly is now dropping to its pre-pandemic share price. On average, the analysts believe that the price target should be about $15, but some believe it can go as high as $28. Analyst reports suggest that Teladoc Health is greatly undervalued at the moment, and the overall consensus is that Teladoc is a buy. And collectively, the analysts believe the company will continue to grow about 4% over the next few years. So with the current earnings per share being minus 1.34, I'm going to have to adjust the earnings per share to be a positive number such as 0.1, as the company is currently making a loss. Based on a combination of past growth and future analyst predictions, I'm going to estimate the earnings per share growth to be about 4%. I'm going to give Teladoc Health a PE of 8. After that, I'm going to project these numbers forward by 10 years. This gives me an estimated future stock price of $1.18 per share for its future share price. Then we need to include our 15% return. Then we work out the current value that Phil Town calls the sticker price, which is 0.29 cents. Now we apply a margin of safety, and at 50% this gives me a buy price of 15 cents, and at 25% this gives me a buy price of 22 cents. Because we're trying to generate a future share price based on a negative EPS, it is making giving this company a valuation very difficult. When I've run this company through a discounted free cash flow model, I've come up with similar results. As Charlie Munger once said, there are 3 baskets, yes, no and too hard, and this one definitely falls into the too hard category for me. The return we would receive if we bought at $12 and sold at the market high of $30 would give us a return of 150%. Teladoc don't have a moat but do own 9.7% of the market share. With the current earnings per share being negative and with the analysts predicting 4% growth, the outlook doesn't look too encouraging as an investor. In addition, they've got a pending securities fraud allegation against them, which is also damaging their reputation. However, their revenue is increasing year on year, and if they can improve their operating profit margin, they may fare much better. Finally, let's summarise what we found out about the company. When reviewing the key pillars, Teladoc Health scored 4.5 out of 12. Under ownership, 2 super investors have sold shares, but none have bought. Historically, the share price boomed during the pandemic, but has since rapidly declined. Analysts are indicating that Teladoc is a buy and are predicting that they will grow about 4% over the next few years. Using the different valuation models, my personal buy price will be less than 22 cents. Under competition, Teladoc doesn't have a moat and they're going through a few issues at the moment. My final overall rating is 0 stars out of 6 and I've given this a category E rating within my own stock watch list. The stock hit some impressive heights during the pandemic but are now having to readjust since the boom. But they haven't ensured the fundamentals of the company have improved significantly enough, even though they have increased revenue year on year. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comments section to help me develop the content I'm creating. And lastly, if you've enjoyed the video, it would be greatly appreciated if you could like and subscribe to help the channel grow.